We also have a bar in Cincinnati that we only got to walk through, not sample. So that should be on our tour as well.
It is. That's where the 5 o'clock.
Whew. Well, that will be well worth the trip for anyone going to Cincinnati. It's a really cool bar. So a lot going on in the global economy. I want to kind of walk you through some of the big things that we're seeing in the tailwinds and headwinds. And, clearly because of all the unusual policy initiatives, as well as just the health and social and political dynamics that are going on, we're seeing all sorts of economic distortions playing out around the global economy. So I want to just touch on the headwinds and tailwinds for the major economies and a few other comments, then we'll move around. But we had a CPI report today that was high, but I would just make a couple observations about it. First is the Fed follows PCE, and that's what's going to determine whether they raise rates or accelerate the tapering, not CPI. And while it's still above 2%, it is significantly lower than CPI. So there's a lot of distortions. A lot of it's coming around the headlines and people focusing on the headlines instead of what really is going on. So I would just say, as a starting point, don't get too caught up in the numbers that you're seeing because there are a lot of distortions. And I'll just give you a sense. In CPI this month, there was a 10.5% increase in used car prices alone. And used car and gasoline or energy accounted for a significant part of the increase. And we don't think those are sustainable. And would anyone want to guess what the price increase on lumber is year to date? It's flat. For all the talk about the move up in lumber prices, they've actually come back down to where they started the year at now. So when the Fed talks about transitory, that is part of what they're looking at. So there are a lot of, interesting dynamics in the economy. So one of the big challenges is, we had a difficult year last year with the pandemic that is really unusual and not something we're, quite frankly, used to dealing with. So what you've had is strong rebounds across the board this year with pretty healthy growth rates for next year, both in the advanced and developing economies. But unfortunately, it's very uneven. The winners continue to win, and the people who have been struggling coming into the pandemic appear to be challenged even more. And so that's a big issue. The second one is the responses are creating big distortions and dislocations in both markets and economies. And that's creating even greater social and political conflict because inequality is growing, not just on a company level or on a individual level, but also on a country level, which is creating some more challenges. And the data is sending mixed signals. You see CPI up, but the Fed looks at PCE. How do you sort this out? And I would say the one thing that is not getting enough press, but is really weighing on policymakers is the issue of economic scarring and how many people are left behind as a result of the pandemic for all the reasons that have been talked about over the last year. So let's just take a look at the U.S. Economic tailwinds and headwinds. And, you have really interesting dynamics. I'm going to touch on some of these on subsequent slides, but one of the unfortunate implications of the pandemic policy response, this goes back not just to the pandemic, but to the Great Recession, is that when you introduce quantitative easing, it's designed to push up asset prices, both securities, home, and all assets in value so that you can manage the debt loads. And consumer net, that has worked. It just creates unequal sharing of the benefits of that. But we have stubbornly high unemployment rates, even though they're improving. We still have a lot of people who are disenfranchised or will be left on the sidelines. So that's where the scarring comes in. You are starting to see some slowdown in some of the economic numbers too, and some of the claims data is softening, rail car loadings are softening, and then gas prices are way up. But let's just take a look at a couple of these. So here's household net worth. And I can just say this is updated as through, I think, April. If you follow it through, we've had a continued move up in the markets, and that's up about $30 trillion for the U.S. Since the beginning of 20. So big moves in net worth. Saving rates have come down considerably, but we still have very elevated savings. And in fact, we could spend down the savings just to historic levels and be adding about 5% to GDP for the next 3 years. So big opportunities in there for as consumers start to experience the reopening for savings and spending to go up. And then railcar loadings, you can see them starting to level off. And since this period, which I think was through March or April, they've started to turn down a little bit. So that is a little bit of a slowing. But some of this is just the catch up and the response to when you have these big protracted moves like we saw last year on the downside and then on the rebound. That's an issue to keep an eye on. And as a real headwind, this gasoline price move. So every 10 cents increase at the pump takes about $13 billion out of consumers' pockets. And as you can see, we've had a significant move up in price. So this is, $150 billion of money coming out of consumers' pockets on an annualized basis. Ironically, some of the things that are coming through from Washington, like the child care credits, are going to put $100 billion back into the economy. So there are a lot of puts and takes. So for us, we're not overly concerned about the U.S. We think it'll still be one of the drivers. China is a very different story, and as the number 2 economy and still growing at a very healthy rate, they do have the benefits of slowing inflation, but they have less effective vaccines. They have done very well by benefiting from the developed markets, the U.S. and Europe improving, because China is they're big markets for China, but they are also developing their own consumer support for the economy, and that's going to help. They've been very good at targeting their stimulus, and they've made heavy investments in the tech sector, although at the same time, their heavy hand is starting to offset that. They did just lower rates and have room to lower rates even further. But it's not a straight, shot for them. So you can see consumer prices and the movements, and this goes back from 2007 to going forward to 2026. And I would just point out, if you look at 2021, the drop that started in 19 and come down, and then we'll see a little bit of a pickup next year. A lot of that, I think, is around energy prices because they're a big importer. Sorry, 1 sec. I'm on pause here. I have to come back into the screen. I apologize. Let's go here. There we go. I'm back. Sorry about that.
No worries.
So you had a bit of a drop, and then you'll start to see a pickup. I think a lot of that's around energy prices. And then why is this not advancing here? And the heavy hand is really one that I think is worth spending some time on. These are some of the companies that have been impacted by China policies. And yet one of the things that made China attractive from an investment perspective is the fact that they have done such a good job in building up some tech giants that, while maybe not competing as effectively globally, will dominate the Chinese market. And these guys are now being brought in under government control, and it's hard to see their innovation continuing at the same rate if they're handcuffed by the government. And these are leading companies with Alibaba and Tencent and JD, Baidu, among some of the biggest companies in the world. And then when you see something like what happened with Didi, where they lost, 30-40% of their value in a couple days after their IPO, they don't want companies listing in the U.S. Is one of the clear messages, or even outside of China. So we think this is going to weigh on the Chinese economy and also on their innovation, and is going to set back one of their big initiatives. And a lot of this is about control of data, and data is the new gold. So I think this is one that it's going to be really interesting to see how that plays out. Shifting to Europe, and for those who've been listening for the last year, you've heard me say on more than one occasion, I have concerns about Europe, mainly around a couple areas. They're way behind in developing a new economy for technology primarily, but they've historically been suffering from a poor institutional structure, meaning when they brought the EU together, they got the monetary side, I think, right, but they didn't get the fiscal side right. And I think that's one of the things that's been holding them back. And this mindset shift from austerity to stimulus that's occurring right now comes at a great time for Europe because it coincides with the reopening and vaccination rates improving. While they still remain very supportive from a monetary perspective, you're now getting support from a fiscal perspective, which is really important. And as we reopen, they're going to get the benefit from the boost to tourism. But I would say that the U.S.-China issue puts them in a really bad spot, and that it's hard to support two major economies that are all telling you to not support the other one. And they do still have terrible demographic issues, and immigration is a big problem for them. And I think the underlying fundamental problem is the divergences of the needs of the populations versus government's ability to deliver inside a country and then inside the EU. And the conflicts that creates some real problems for them. So inflation is not one of the problems. In fact, you could argue that getting a healthier inflation level is going to be very important. And I think you'll see that out of Europe on the reopening. But they have really difficult unemployment problems. And you just look at the chart here, about 45% of the countries in the European Union have unemployment rates of over 6.5%. And youth unemployment, while it's down now, it's still around 14.5% for the EU, down from around 18% in normal times and over 22% during the last two financial crises. But that said, I think Europe is starting to come around. They're moving past the Brexit issues that's weighed on them. That created a lot of problems for companies to decide how they're going to operate in a post-Brexit world. You've had a lot of problems here, but I think that there are better times ahead. I still think they have an issue being a little behind on tech, but there is opportunities for them to continue to move forward. So, we think the U.S. and China are going to continue to be the leaders in driving growth. China is actually trying to manage their economy by slowing it down a little bit so that they don't have the high inflation. It allows them to control their economy better, but both economies are doing quite well. I haven't touched on Japan, which is the third largest economy as a country. If you put in the EU, it's fourth. But I would just say that in terms of what Japan's doing, I think they're in a tough spot. They have demographic issues that are real. They have competitiveness issues that are problematic. Their immigration policies or how they feel about immigration is not one that's going to support their demographic issue unless they have a dramatic change. But I do think overall there are opportunities. As the global economy does better, they can do better as well. We like what's going on in Europe, but we are not rushing to invest there. We think the variants can be a real issue that I don't think we're out of the woods yet. And people forget that the fourth wave for the Spanish flu came almost 2 years in 2020, not in 2018. So there are other legs that to this process of going through a pandemic. And the other issue is vaccination rates in the U.S. and some of the other countries are slowing. You're seeing a big move in Canada, for example, but as we start to slow down, if we don't get our vaccination rates up and continue to push them up, we're going to have a problem. And I think the bigger issue that we're going to be facing from a macro perspective is the policy transitions, particularly the timing of reducing QE and raising rates. And that has the market a little bit out of whack. So Bank of America had a fund manager survey, and they were talking about inflation and some of their other prospects. And 70% of respondents think inflation is transitory, down from 72 last time the survey was done a couple months ago. 26% think it's permanent. The rest are undecided. They also expect the first rate hike not to be until January of 23, which has been pushed out from the May survey where it was November of 22. So we think we're in one of those periods where the U.S. will continue to do quite well. We don't think that tax increases will be as big a concern in the near term. They're probably more of a 2022 issue, and we think Washington's going to have problems getting their agenda put through. And the longer it takes to get that done, the more difficult it's going to be for the Democrats to force things through when the midterms are rapidly approaching. So we would expect both the bipartisan bill in some form and a reduced reconciliation bill coming from the Democrats that won't be as high as originally proposed. And that sets us up for, in our view, for a pretty healthy continued movement in the economy to move up. We think with this earnings season, people should be focused very much on two things: companies that are growing their earnings and companies that have the ability to improve margins either by reducing costs, passing on price increases, or both. So I'll stop there, Mark, and we can open up for questions. Okay, then we can move on to the next session.
I have a question.
Questions, comments?
I have one too. Cue me up after whoever just. I'll go second with the question.
Go ahead, Gregory.
I was to all the attendees. Given the newness of the crackdown, again, the new information on the crackdown on big Chinese companies, is there anybody from the private equity side have any views on potential exit strategies now that perhaps the New York Stock Exchange and NASDAQ listings are off the table? And if that's going to change the views on private equity in China?
Great question.
There's still I'll take that. There's still, let me speak to it more from a venture perspective than a private equity perspective. But there's still a tremendous amount of entrepreneurial enthusiasm in the venture capital space in China. It's grown dramatically, continues to grow. There will be new company formations, and I'm not as concerned about the issues with the U.S. market because most of the activity is M&A. If you take a look at the liquidity events, more than 90% of it, or close to 90% of it, is M&A, not IPO. And the European and Hong Kong markets are wide open. So I don't think that. I think that's looking at the U.S. reaction is putting the cart before the horse.
Thank you.
I would just echo Todd's comments, and I think also bringing back one of the comments that Stephen made is that China has a policy. I mean, they are absolutely determined from a policy standpoint to develop the consumer economy. And that can't be done on the back of SOEs. It's not going to happen with state-owned enterprises. So there is huge, huge support for innovation in China. And my former colleagues at Morgan Creek, continue to see amazing, company formation in China. So that's just not going to stop. The only question then, for those guys, and it's further out down the road, is where do you list? So, don't hold your breath on anything stopping in China.
But the issue, Bill, isn't it part of the issue? The rule book is now completely changed in terms of if you're a entrepreneur, you're following a playbook that's different than the one that Jack Ma followed.
I don't think necessarily the playbook has changed that much. There has always been a sensitivity to running crosswise with government policy. I think Jack probably got sideways with those guys. He got big enough. He didn't think perhaps that that the government would come after him, which is a huge mistake. I think one of the issues is that China wants companies to grow. They want them to start. They want them to grow. But once they get too big, then they have to be careful. And and even in company formation, you have to be very careful because what you want to do is you want to align yourself with governmental policy, but you don't want to get into the areas where there is sensitivity. So for instance, again, kind of going back to my Morgan Creek days, we were very careful to avoid companies that were getting involved with big data, because that is something that China will never, ever, let go. That's why you don't see Google there. That's why you don't see Uber there. It was all that information. And that's why Didi had the head start, and Tencent and all those guys. So it's really being aware of the sensitivities with the government policies and staying away from those. And I think that, once again, that list of companies that you showed was really great. And I think that it just is an illustration of when you think you get too big, for the government to touch you in China, not true.
Well, ironically,
and
it's the same thing's happening in the U.S. So
Yeah,
we're doing something similar to our companies.
These mega unicorns capture the headlines, and there's a lot of exit activity below that.
Mm-hmm.
Well, this deserves its own deep dive. But there are a couple other questions, and in 4 minutes we have the Africa deep dive. What are the other questions?
I've got a question about Europe. Stephen, you're talking about demographic and immigration issues. I lived in Europe for like over 20 years, and I want your feedback on this idea of the low birth rate in some European countries as, in a sense, kind of an immigration or demographic issue. I think already you've got Germany and Italy who are both have negative birth rates, which in a sense kind of creates a tension between this idea of the need for them to bring in workers, not just to fill positions, but also to pay into their social system, and the tension between that and, you could say, a kind of a nativist sentiment that's going on in these countries. Can you comment on that?
It's a real conflict. To grow, most countries are going to need immigration policies that are much more effective than they have. And you look at some of these, the U.S. included, as good as our immigration is, we need to really expand it. So I think most of the world is going through, except for Africa, and parts of Southeast Asia is in population decline. And we're going to have to find ways to deal with that, to be more productive. And I think that's going to be an issue for Europe. It's an issue for Japan, is in negative population movements. They're losing about 500,000 people a year. So that's not a good setup and not great for growth. So I think that's an issue we're going to have to face. Mark, John had his hand up. I don't know if we have time for one more before we start.
John?
I'm okay. We could skip. It's fine.
Yeah, well, John, I will be looking for I'll be leaning on you on the Midwest tour. We'll talk soon.
That's great. And I guess I do have one announcement for Susan. It's a little bit late, but the person who runs Paul Tudor Jones' Africa Initiative has agreed to support us going forward. He may not be able to make today's call, but we got to the right person, and we're going to get a lot of support there. So let's rock and roll.
Rock and roll.